So since we last spoke, we haven't actually made any changes to our SAA, our strategic models. We've had several meetings. We meet monthly. We've had several meetings, and in each one, we've obviously discussed what's been going on, whether or not our portfolios needed to have changes. And our assessment was that we were reasonably well positioned. We're a little bit underweight growth. We had an overweight position to property and infrastructure, which is not a bad place to be when you've got high inflation. We're underweight Aussie equities, and and we're overweight. Well, relative to Aussie equities, we're overweight global equities, and I think if you've got a lot of global equities, you can't help but have a lot of US equities. And in particular, we do have some diversification around the big tech companies, but we've got plenty there. We've also, as Jonathan mentioned earlier, had an overweight position to emerging markets since late last year. So our assessment has continued that we haven't really needed to change. I think in times such as these, your best friend, I think, is diversification and probably quality. Quality stocks
Yeah.
haven't actually performed that well. And that's probably caused our portfolios. They've still done okay. They've held up, but perhaps not to have done as well as they have in the past. But when you go through difficult times, you probably want companies with strong balance sheets and good long-term diversified investment strategy. So we've retained that positioning, not for all of our portfolio, but for a significant enough part of our portfolio. And then, of course, in the fixed interest and defensive space, again, quality is king. And as Jonathan mentioned earlier, we've been underweight long-term fixed term duration, both in Australia and the US or globally. And we've had a good exposure to high quality credit, mostly floating rate credit. We haven't dipped into the high yield space, your lower quality bonds. But we have actually allocated sort of late last year or early this year to a manager that can tactically go into that space. But for the most part, we're quality, lower duration than the index. So we're quite happy with how that was, and we haven't felt the need to make any changes. Notwithstanding, we're always looking at it, and we're always reviewing the various fund managers that we have in there. On the tactical asset allocation component of the portfolios, we've taken the opportunity to increase our exposure a little bit to growth, and we've done that in three small pieces of buying in March and April. So that's been fine. But again, we're still underweight, a little bit underweight in that portfolio. So, and again, very, very diversified.